Welcome to our Forex Basic Education course. In this course, you're going to learn the basic fundamentals of trading in the foreign exchange. We're going to teach you about price movement, the importance of time, separation of different currency pairs, the correlation with different currency pairs, and much more. First, we're going to give you a few simple rules that you're going to apply along with our methodology over the next 2 weeks. We recommend you use a practice account for the next 2 weeks to follow our methodology, along with our alerts and explanations on why we enter in specific trades. Before we continue, it is very important to know the risks behind trading in the foreign exchange. Please read the risk disclaimer before we continue. First, we need to familiarize ourselves with candlestick charts and the different time frame we can use while we're trading in the foreign exchange. First, I would like to go over the definition of candlesticks. A candlestick is a style of bar chart used primarily to describe price movement. Now understand, this is very important. All we're going to concentrate on is the price movement of candlesticks. We're not going to worry about different formations. We're not going to worry about different patterns. All we would like to know is the price movement. Now on the bottom it says each bar represents the range of price movement over a given time interval. That's all we need you to focus on. For now, all you're going to concentrate is on the price and the amount of time it took, depending on the time frame that we're using, for a candle to form itself and the price to move from a certain time to a certain time. Now allow me to give you an example. Here we have a Euro USD 5-minute chart. Take a look on the left hand side. We have a candlestick in green. I want you to look to the right. The price was 123.04 and it moved to the top 123.14. That's a difference of 10 pips in this one 5-minute candle. Because I'm using a 5-minute chart, obviously each candle represents 5 minutes of information. In this case, 5 minutes of price movement from 12:10 to 12:15. Now we're going to be basing a lot of our information using a 5-minute chart. We're going to give you a few examples on the difference between a 5-minute chart and a 1-hour chart. As we mentioned before, the only difference, if you're looking at a 5-minute chart and a 1-hour chart, the price, depending on the time, is going to be exactly the same to the right. But when you look at the candlesticks and the difference between a Euro USD as we have in this chart, take a look to the right. Here's 1 o'clock in the afternoon, 2 o'clock in the afternoon, 3 o'clock, and so on. Each candle represents 1 hour worth of information or price movement. Here you can see that from a certain time at 1 o'clock, the price movement dropped. At 2 o'clock, for that single hour, the price movement moved lower. And then at 3, within an hour's time, the price movement moved up before coming back down. The reason we use shorter time frames, as you can see here on a 5-minute chart, you can see the difference between 1 and 2 p.m. in the afternoon. We simply have more candles giving us an idea of the price movement in between the trading session that we're trading. We want more information. We want more of a visual in order for us to understand what the price movement has been doing for our entries and to define the trend of the market. So for now, simply focus on the price movement, and most of the examples that we're going to give you are going to be based on a 5-minute time frame. As part of our methodology, our second step is extremely important and happens to be the foundation of this education. It is very important to learn how to separate, or the reasons why we separate, the 3 different sessions of the day. We have the European session, the US session, and the Japanese session. Allow me to show you the separation of all 3. Here we have the Japanese session, which starts at 8 p.m. New York time to 2 a.m. New York time. The European session starts from 2 in the morning to 7 in the morning, New York time. And the US session starts from 7 a.m. to 5 p.m. New York time. Now you're probably asking yourself, why is it important to separate each session? Allow me to give you an example. Here we have a basic chart of the British pound US dollar during the Japanese session. I want you to focus on the lower part of this chart, 8 p.m. to 2 a.m. And I want you to take a look at the price. The price here was 148.05. As time went on, the price moved from 148.05 to 148.74. And as we reach the end of the Japanese session, take a look at the price, how it moved from 148.05 to 149.37. This is a beautiful uptrend during the Japanese session. This is what our chart looks like towards the end of a session. You can't see to the right because that's the future. But many traders use past performance to try to predict what the future price movement will be. Now, any beginner, if you take a look at this chart and you ask him to place an order, whether to buy or to sell, those are the only two choices we have. Most likely than not, they will say we would like to place a buy order. Why? Because we've seen in the past the price movement move from 148.05 all the way to 149.37. Common sense, we wouldn't want to sell this currency pair. We would want to buy because we've just come off of a very important session and we've seen the price movement going up. We have no idea what's about to happen in the future, but our best bet is to place a buy order. Now allow me to show you in this next example. Here we see the new session, which is the European session, and the price movement has gone down from 149.27 all the way down to 148.35. Almost down 100 pips. This is the reason why we separate each trading session of the day. When the Japanese market opens, we have different investors, different companies, different banks that are making different transactions every single day. If we separate each session, for example, the Japanese session, as we saw the trend moving higher, we decided to buy. And towards the end of the Japanese session, we stopped trading, took in whatever profit we had, and allowed the European session to start and gave the market enough time to develop before we thought about placing any more trades. Our success ratio would probably be a lot better than just trying to anticipate the price movement or guessing, as you've seen in this example. If we would have bought based on the Japanese session and the information of the price movement, we would have been wrong. So it's very important for us to separate each session. We're not trying to guess the price movement. We're trying to make an intelligent decision based on the price movement before we decide to buy or sell a currency pair. And this is why this is the foundation of our course. We must separate and give the market time before we start thinking about placing any orders. Which brings us to our next example. Step 3 is trend recognition. Before we can decide to place any trades, we must have an idea of the direction of the market. But first, in order for us to understand the direction of the market, we have to have a starting point. As we mentioned before, we have 3 different sessions. We have the Japanese session, we have the European session, and we have the US session. Here we have the British pound, which you can see on the bottom, 2 a.m. to 7 a.m. This is the start of the European session. And we have a starting price. The starting price at 2 in the morning will be used as a reference point. This will be our starting point to determine whether the price movement is moving higher or if the price movement is moving lower, therefore giving us an idea of the direction of the market. Now take a look at the price. Here we can see the price was at 149.30, and towards the end of the European session, the price moved lower to 148.30, giving us an idea of the price movement or the trend being down. In this step, we must have a starting point, and that starting point will be the first candle or the open price for the session that we're trading. If you're trading the Japanese session, you will take the open price at 8 p.m. New York time. If you're trading the European session, you will take the open price at 2 a.m. New York time. If you're trading the US session, you will take the open price for 7 a.m. New York time. Our second step in understanding how to determine the trend in the market, we must give the market at least 2 hours before we think about placing any trades. You're probably asking yourself, why 2 hours? It's to give the market time to develop. Time is a very important factor when we're trading, especially in the foreign exchange. Allow me to give you an example. In this chart, we have the British pound US dollar, 5 minutes, and take a look at what happened during the previous session. We had a downtrend. This line represents 7 o'clock in the morning, New York time. As you can see, the open price was $148.95. And we gave the market 2 hours worth of time to allow it to develop itself. And towards the end of the 2 hours, you can see the price movement move from $148.95 to $149.60, therefore giving us a better idea of the direction of the market. Take a look at the left. On the left side, you can clearly see that the trend was down for the European session, and during the US session, the trend changed. This is the reason we must allow the market to develop before we think about placing any orders, whether it be buy orders or sell orders. The third step for trend recognition is the price movement from the starting price. Now, take a look here on the left-hand side. We have the starting price of $148.50, and you can see clearly the trend was moving lower. It moved to $148.07, but it wasn't 2 hours just yet. The price movement started going up. By 9:05 in the morning, the price was at $148.49 from the open price of $148.50. Even though the trend seemed to be moving lower towards the first hour worth of trading, towards the second hour, we can see that the price movement started going back up. It's not a good idea to start placing sell orders or buy orders when we have the open price and the price after 2 hours almost at the same level. We want the price movement to be further away from the starting price by at least 40 to 50 points on the pound, anywhere between 35 to 40 pips on the euro. This is a perfect example of why we have to be patient when we're trading. If we see the price movement moving in one direction, as we see here, and towards the next hour, we see the price movement moving back to the same level of the open price, we should be patient and hold off on trading until we see a clearer entry point or a clearer picture of the trend moving in one direction or the other. Allow me to give you another example. Here we can see the European session, the open price for the US session at $148.90. And take a look at the price movement. After 2 hours, it moved higher to $149.58. This is what we look for when we're looking to determine the direction of the market. As you can see, the open price of $148.90 and the end price after 2 hours is $149.58. It's more than 60 pips on an uptrend, giving us a good idea of the direction of the market and giving us more reassurance for us to place buy orders. So on step 3, we must allow the price to move away from the open price of the start of the session that you're trading. And if you're giving the market 2 hours to develop, then that price should be further away by at least 40 to 50 pips on the pound and at least 35 to 40 pips on the euro. Our fourth step for trend recognition is support and resistance levels. Now, support and resistance levels, whether we're trading or separating each trading session, is commonly used in technical analysis by many traders around the world. Some traders look back as far as a year, 2 years worth of price movement to get reference points. We're going to show you the importance of reference points or support and resistance levels during the trading session that you're trading. For example, take a look on the left-hand side. Here we have the British pound US dollar 5-minute chart. Starting price, $148.45. Now take a look at the time on the bottom of the screen, 7:15 in the morning, all the way to 8:45, 8:55, and approximately 9 o'clock right about here. At the beginning of the trading session, the price moves higher from 148.45 to the highest level of 148.65. This would be a great reference point if the trend were to move higher, or for us to start thinking that the trend will be moving higher later on. And now take a look at the price as the price moves lower to 148.10 just before 9 o'clock in the morning. So now we have two reference points. One happens to be 148.65 and the other happens to be 148.10, which is our support level. And take a look at what happened after 8:45 in the morning. We had the price retrace or move back up to approximately 148.40. Then it started moving back down. Then it started moving back up to approximately 148.50. Because we have these two reference points of 148.65 and 148.10, we would wait for the price to move either lower, breaking that 148.10 to 148.05, 147.90, or having the price move past the session high of 148.65 and making a new high of 148.66, 67, and so on, in order for us to determine or start thinking that the trend is up instead of down. See, these two reference points become what we call support and resistance levels, but they're very important, especially when they're made at the beginning of the trading session. And the further apart they are, the better it is for us, because later during the session, as the price movement stays in the middle, eventually it will break one of these two reference points. And if it continues making newer lows and it breaks the 148.10 to 148.09, 148.08, and so on, that will give us more of a confirmation of a downtrend. Allow me to give you another example. Take a look at the screen on the right hand side. This is part of step 4. We must wait for a good retracement in the opposite direction of the trend. At least 20 to 25 pips for the GBP USD and 15 to 20 pips for the Euro USD to eventually come back down and break a newer level. Now, we're going to use in this example support and resistance levels as well as that retracement feature that we mentioned. Now take a look on the left hand side. We have our open price of 163.06. We have a session high of 163.19, and we have a session low of 162.70. Take a look at the price movement, but first, this happens to be 7:20 in the morning. Our reference points, which is our support, and our resistance level were made within the first half hour, 30 minutes of the trading session in the US. Now take a look at the price movement after we made a new low of 162.70. The price movement started going back towards the middle ground, eventually looking to move higher, but it did not break the session high. Eventually, it did come back down past 9:30 in the morning to break the lowest level of 162.70. This is what we look for in order for us to determine the trend in the market, or to give us a better idea of the market's direction. Now, the retracement level becomes more of a confirmation of the market direction. Take a look at what happens. Once we reach the lower levels of 162.70, the price starts moving back up to the open price of 163.06. As we mentioned, we always want the price to move away from the session open, or from the open price of the start of the session. Therefore, we're not looking to place any buy or sell orders at this point because we're back at square zero, open price. But take a look at what happened after. The price starts moving lower and eventually breaking the lower level of 162.70 to 162.60, 162.55, 162.40. The key in this example is not only support and resistance levels that were made early on as reference points, but eventually this big retracement. Once the trend was down, at least we thought it was down for the moment, we had a pullback of more than 15 to 20 pips to eventually have the price come back down and make a newer low, giving us a better indication of a downtrend. These retracements are very important when we're trading. Why? Because we have to give the market not only time, we have to give it room to breathe. These retracements are going to become very important factors, especially for our risk management. We will get into that later on in the session. First, remember, as part of our trend recognition, we must have a good retracement in the opposite direction of the trend for it to come back down, as we see in this example, to make a newer low, giving us more proof, giving us more confidence to place sell orders based on the information we have in front of us. Now, just before we end this topic, we would like to give you an observation and a reference when you're trading in the foreign exchange. Normally when the trend, as you can see here in this example, after 9 o'clock in the morning, we could remain consistent in the trend until 11:30 to 12 noon. This time during the US session can be the most dangerous session to trade because Europe is starting to prepare itself to leave the market. This is when we can see larger retracements than normal and even possible reversal levels happen during that time when Europe is leaving the market. So when you're trading in the foreign exchange, if you're about to place a trade in the direction of the trend at 11:30 in the morning, you might want to hold off till approximately 12 noon, maybe 12:30, to make sure the trend will continue after Europe has left the market. So keep that in mind when you're trading in the foreign exchange. 11:30 to 12 can be a tricky time to trade because of the possible volatility on the reversal levels or retracement levels because of Europe leaving the market. Now, to recap what we've learned, remember, to determine the direction of the market, number one, we must have a starting price. Number two, we must give the market time to develop. Number three, we must let the price move away from the session open depending on the session we're trading. 40 to 50 pips on the pound, 35 to 40 pips on the euro. We must also wait for a good retracement to give us a better confirmation of the trend of the market. Before we move on to our last topic, it is very important to keep in mind that using this strategy does not guarantee profits, as market conditions could vary and currency trading involves substantial risk of loss and may not be suitable for all investors. Last step in determining the trend for the different sessions of the trading day. We have to understand the correlation of different currency pairs. Not only is this good to apply for understanding the trend or the direction of the market, but this is also very important for when you're looking to place your entries. Allow me to give you an example. Take a look at these two charts. Here we have a GBP USD 5-minute chart. Take a look to the right. We have a Euro USD 5-minute chart as well. I want you to take a look at the price movement. Here we have the British pound forming a V, price moving back up, eventually going back down to the lower levels of 147.40. Now take a look at the euro. We also have a V shape, price movement moving back up to eventually come back down to make the newer lows at 123.20. What are we trying to show you? We're trying to give you an example of why it's important to view more than one currency pair when you're trading in the foreign exchange. Because there's a correlation between different currencies like the euro and the British pound, it's good to view them together. When you're looking to determine the trend for the euro, it's good to have a British pound chart, same time frame, to give you reference points. If we can see here, the trend was moving down, and I look to the left and the British pound is also moving down, consistent with my expectations and the price movement, I will feel a lot more confident if I'm looking to place a sell order, and not only do I have one currency pair moving down, but also having another currency pair like the British pound doing the same thing. And for an even better confirmation, instead of just using 2 different charts, we can use 4. The British pound dollar, euro dollar, 5-minute charts. Also, we can add the US dollar Swiss franc, which will be reversed because the US dollar is first and the Swiss franc is second. And the US dollar Canada, also 5-minute chart. Now take a look at these 2 graphs. You can see the price moving down, eventually to come back up. Look at the US dollar CAT. Looks a lot nicer, a lot cleaner, but look at the V shape and then the price movement moving up as well. That would be a perfect correlation if we had 4 different charts, as you can see here, and we had the price movement for the pound moving up, the Euro USD moving up, and having the US dollar Swiss franc moving down, along with the US dollar Canada moving down. Once again, when we're trading, we need reference points. We want reassurance. Anytime we can get a clearer picture of the direction of the market to place our trades, the better our results could be. So this is another example how you can give yourself more reassurance while you're trading. Remember, in the market, we're never going to be 100% accurate when we trade, but we want to limit our risk. And this is another good example on how not only to limit your risk, but this is another example on how to confirm the price move.